Traditional IRAs, Direct Transfers and Tax-Free Rollovers. Part 8. Direct transfers and tax-free rollovers are two different ways to move investments from retirement accounts to IRAs. If done properly, you can avoid creating a taxable event. A rollover may appear similar to a transfer with respect to the mechanics, but it is a very different operation. A direct transfer is a movement of funds between the same type of accounts, such as from one traditional IRA to another traditional IRA, where there is no distribution to you. The money is transferred directly from one financial institution to another on your behalf, and it is also known as a trustee-to-trustee or custodial transfer. You can transfer all or part of your account to another IRA trustee. You can also split your account and transfer the funds to more than one IRA trustee. For example, let's say you have an IRA at your bank, and you've decided to diversify and split the funds between an IRA at 3 different mutual fund companies. You request the direct transfer, and the money is sent directly from the bank to the 3 different mutual fund companies. This is not a taxable event. One of the key benefits of a direct transfer is that you can process a direct transfer as often as you wish. With a direct transfer, since you do not take possession of the distribution from your traditional IRA, the funds are transferred directly between the trustees. You may incur a charge from the trustee each time you transfer, but there are no taxes or penalties with a direct transfer. Let's look at a direct transfer scenario. Sandy owns a traditional IRA at XTC Mutual Funds, and she's not happy with the performance of her investment. She completes a direct transfer of account to URY's mutual funds. 2 months later, Sandy decides to do a direct transfer of the funds from URY's to a traditional IRA in a CD at her bank. What are her taxable consequences? Direct transfers are tax-free because she never had possession of the funds. Even though she processed more than one transfer within the year, she does not have to pay taxes on the transfer. You can process an unlimited number of direct transfers without tax or penalty. However, each trustee may charge an annual maintenance fee, and that will add to the cost of your transfer. Now let's look at a tax-free rollover and see how it's different from a direct transfer. A tax-free rollover is the movement of funds between 2 types of retirement plans that may be different, such as a 401k plan to an IRA. Rollovers may be subject to federal income tax unless all requirements are met. With a rollover, you actually receive the funds from the retirement account. Amounts not rolled over within the 60-day period are treated as a taxable distribution for the year you receive the distribution. In addition to the taxes on the distribution, the 10% penalty also applies if the distribution occurs before age 59.5, and an exception does not apply. During the 60-day rollover period, you can use the money as you desire. Some people look at it as a short-term loan. As long as you reinvest the funds into an IRA within the 60-day period, the distribution is tax-free. Here's one of the key differences between a direct transfer and a tax-free rollover. There's a once-a-year rule for tax-free rollovers. A tax-free rollover may only occur once in a one-year period, starting on the date you received the first distribution. If you receive a distribution from a previously rolled over IRA within that one-year period, the distribution is taxable, and the 10% penalty would apply if the distribution occurred and were under age 59 and a half. Let's look at a tax-free rollover scenario. Sandy quits her job and decides to take the funds from her 401k rather than transfer the funds directly to an IRA. She deposits a check for $10,000 into her personal bank account. Within the 60-day period, Sandy deposits the entire $10,000 into a traditional IRA at URWise Mutual Funds. What are her taxable consequences? Since Sandy reinvested the entire $10,000 into a traditional IRA within 60 days, this is considered a tax-free rollover. However, unlike a direct transfer, you can only process one tax-free rollover of the same funds every 12 months. Let's look at another scenario. Sandy owns a traditional IRA with XTC Mutual Funds and decides to use the money for a trip to Las Vegas. She withdraws the funds and takes off for a week of sun and gambling. After a run of luck at the craps table, Sandy returns home with more than $10,000. She deposits the $10,000 back into her IRA at XTC within 60 days. What are her taxable consequences? As in the previous scenario, this is also considered a tax-free rollover, since Sandy reinvested the entire $10,000 back into a traditional IRA within 60 days. Traditional IRA funds may be used as a short-term loan, but if the funds are not returned to the original or a different traditional IRA, taxes on any growth of the investment and premature distribution penalties may apply. Let's look at a different scenario. Sandy owns a traditional IRA with XTC Mutual Funds and decides to use the money for a trip to Las Vegas. She withdraws the funds and takes off for a week of sun and gambling. This time she has a bad run of luck at the craps table, and she returns home with only $5,000, which she deposits back into her original traditional IRA within 60 days. What are her taxable consequences? The $5,000 Sandy did not roll over into a traditional IRA is taxable, the actual amount depending on whether the original contribution was deductible or non-deductible. The 10% penalty would apply if the distribution occurred and she was under the age of 59 and a half. Traditional IRAs, Required Minimum Distributions. Part 9. Required minimum distributions, or RMDs, generally are minimum amounts that a retirement plan account owner must withdraw annually, starting with the year that he or she reaches 70 and a half years of age, or, if later, the year in which she retires. Required minimum distributions from your traditional IRA must begin by April 1st of the year following the year in which you reach age 70 and a half. RMD distributions from a traditional IRA are fully taxable unless some of your contributions were non-deductible. Any deductible contributions and earnings you withdraw or that are distributed from your traditional IRA are taxable. You cannot avoid tax on an RMD by rolling it over into another account. If the account owner fails to withdraw an RMD, fails to withdraw the full amount of the RMD, or fails to withdraw the RMD by the applicable deadline, the amount not withdrawn is taxed at 50%. If you are subject to the penalty, you should figure it on Form 5329 and attach it to Form 1040. If the account owner establishes that the shortfall in distributions was due to reasonable error and that reasonable steps are being taken to remedy the shortfall, the penalty may be waived by the IRS. In order to qualify for this relief, you must file Form 5329 and attach a letter of explanation. Let's look at an RMD penalty scenario. Fred's RMD for the year was calculated at $4,000, but he only received $3,000. Unless the IRS waives the penalty for Fred, he would have to pay a penalty of $500, or 50% of the $1,000 he failed to remove from his traditional IRA. The custodian or trustee of your traditional IRA must calculate or offer to calculate the amount of your RMD. However, the owner of the IRA is ultimately responsible for calculating the amount of the RMD. Generally, a RMD is calculated for each account by dividing the prior December 31 balance of that IRA or retirement plan account by a life expectancy factor that the IRS publishes in tables in Publication 590, Individual Retirement Arrangements, IRAs. If you own more than one traditional IRA, you must calculate your RMD for each account. However, you are not required to take your actual RMD from each account. You may take your total RMD from one account or spread it from several accounts. Let's look at a multiple account scenario related to RMDs. Fred must take his RMD for the year. He owns 3 different IRAs with 2 different custodians. His RMD is $2,000 from Company A and $1,000 from Company B. If he has the funds available, he can take the entire $3,000 from either company or break it up any way he chooses, as long as he takes the $3,000 in total. The IRA account owner is taxed at his or her income tax rate on the amount of the withdrawn RMD. However, to the extent the RMD is a return of basis, it is tax-free. Traditional IRAs, Inherited IRAs, Part 10. Inheritances are generally tax-free. However, distributions that you receive as a beneficiary of a traditional IRA are taxable. With an inherited IRA, you must take annual distributions no matter what age you are when you open the account. This doesn't apply if you've simply transferred another IRA to your own IRA. Generally, you must take distributions during your lifetime or within 5 years after the original account holder has passed away. With an inherited traditional IRA, you'll pay taxes on any distributions you take. Rollover, SEP, and simple IRAs become inherited traditional IRAs. If your spouse was under 70 and a half when they passed away, you have several options. You can process a spousal transfer. You can open an inherited IRA using the life expectancy method. You can open an inherited IRA using the 5-year method, or you can take a lump sum distribution. If the deceased is under 70 and a half, and you decide to process a spousal transfer, you actually transfer the assets into your own existing or new IRA and treat it as your own. The money is available to you at any time, but the premature withdrawal penalty applies if you make the withdrawal before you reach the age of 59 and a half. A spousal transfer is only available if you are the sole beneficiary. As with any other traditional IRA, assets can continue to grow tax-deferred. You may also designate your own beneficiary. If the deceased is under 70 and a half, and you choose the life expectancy method, you transfer the assets into an inherited IRA that is held in your name. Distributions from an inherited IRA using the life expectancy method must begin no later than 12/31 of the year the account holder would have reached age 70 and a half. With the life expectancy method and the deceased under 70 and a half, your annual distributions are spread over your life expectancy. If there are multiple beneficiaries, separate accounts must be established by 12/31 of the year following the year of the death. If this is not done, distributions will be based on the oldest beneficiary. Unlike the spousal transfer, you will not incur the 10% early withdrawal penalty. Undistributed assets can continue to grow tax-deferred, and you may designate your own IRA beneficiary. When using the life expectancy 5-year method and the deceased under 70 and a half, there are some similarities between the straight life expectancy method. With the 5-year method, you transfer the assets into an inherited IRA held in your name. However, money is available at any time up until 12/31 of the 5th year in which the account holder died. At that point, all assets must be fully distributed. With the 5-year method, you are taxed on each distribution, but you will not incur the 10% early withdrawal penalty. Undistributed assets can continue to grow tax-deferred for up to 5 years. You may also designate your own beneficiary. With a lump sum distribution and the deceased under 70 and a half, all assets are transferred to you and no IRA is set up for you. The money is available immediately. You will pay income taxes all at once, but you will not incur the 10% early withdrawal penalty. You may move to a higher tax bracket depending on the amount of your distribution and your current income tax level. We've just discussed inherited traditional IRAs if your spouse was under 70 and a half when they passed away. Now we'll discuss inherited traditional IRAs if your spouse was over 70 and a half. You also have several options. You can process a spousal transfer. You can open an inherited IRA using the life expectancy method, or you can take a lump sum distribution. Just as with a spousal transfer with the deceased under age 70 and a half, you also transfer the assets into your own existing or new IRA and treat it as your own. The money is available at any time, but the premature withdrawal penalty applies if you make a withdrawal before you reach the age of 59 and a half. Just as with a spousal transfer with the deceased under age 70 and a half, a spousal transfer is also only available if you are the sole beneficiary. As with any other traditional IRA, assets can continue to grow tax-deferred, and you may designate your own IRA beneficiary. If the deceased was over 70 and a half, you must take an RMD for the year of the death if the account holder did not already take it. If you are under 59 and a half, you will be subject to the same distribution rules as if the IRA had been yours. So you cannot take distributions other than RMD for the year of the death without paying the 10% early withdrawal penalty. With the life expectancy method and the deceased over 70 and a half, you also transfer the assets into an inherited IRA that is held in your name. Undistributed assets can continue to grow tax-deferred. You may designate your own beneficiary, and you will not incur the 10% early withdrawal penalty. You must begin taking an annual RMD over your life expectancy beginning no later than 12/31 of the year following the original account holder's death. If the original account holder did not take an RMD in the year of death, an RMD must be taken from the account by 12/31 of the year the original account holder died. With the life expectancy method and the deceased over 70 and a half, your annual distributions are spread over your single life expectancy, determined by your age in the calendar year following the year of death and reevaluated each year, or the deceased account holder's remaining life expectancy, whichever is longer. With the life expectancy method and the deceased over 70 and a half, if there are multiple beneficiaries, separate accounts must be established by 12/31 of the year following the year of death. Otherwise, distributions will be based on the oldest beneficiary. Required minimum distributions are mandatory, and you are taxed on each distribution. With a lump sum distribution and the deceased over 70 and a half, all assets are transferred to you and no IRA is set up for you. Money is available all at once. You will pay income taxes on the distribution all at once. You will not incur the 10% early withdrawal penalty. You may move to a higher tax bracket depending on the amount of the distribution and your current income level.